You ever log into your retirement account and just kind of stare at the number? Not because it's amazing, but because you're trying to figure out, is this good? Is this bad? Should I feel proud? Should I panic? You see $82K or $214K or maybe $487K, and you have no idea whether that number means you're ahead, behind, or completely delusional about when you can actually retire. Meanwhile, someone on social media is talking about retiring at 35 with $3 million. Your coworker says they're doing fine. Your parents tell you it'll work out, and you're just sitting there thinking, am I missing something? Here's the thing, most people don't need a perfectly optimized retirement strategy. They need to understand the takeoff points, the milestones where everything changes, because retirement isn't linear. It feels slow, and then suddenly it accelerates. Today I'm gonna walk you through the 3 retirement net worth milestones that change everything. Not random numbers, not you should have X by 40, but the 3 levels where the math, the psychology, and the optionality of your life fundamentally shift. My name is Tom, and I spend way too much time thinking about retirement math and how normal people can actually win at it. If you're someone who feels behind, overwhelmed, or unsure if you're doing enough, make sure to hit the subscribe button and give this video a thumbs up if this helps you out. Look, let me challenge something right away. The biggest myth in personal finance is that retirement is about hitting one magic number, like $1 million or $2 million. That's not how this works. The reality is, there are stages, and each stage changes how money behaves. Let's start with milestone number 1, the survival threshold. For most people, this happens somewhere between $100K and $250K invested. Now, you might be thinking, Tom, that doesn't sound like retirement money. Exactly. That's the point. This first milestone isn't about retiring. It's about power. According to data from the Federal Reserve, the median retirement savings for Americans aged 55 to 64 is around $185K. Let that sink in. People within 10 years of retirement, median $185K. So when you cross $100K invested, you are already ahead of a shocking percentage of people. But here's why $100K to $250K matters mathematically. Let's assume a long-term average return of 7% after inflation. Historically, US markets have returned around 10% nominal over long periods, according to research from Vanguard, but inflation eats part of that. So let's be conservative. At $100K, 7% growth equals $7K per year. You didn't work for that $7K. You didn't negotiate for it. You didn't stay late for it. Your money did. Now imagine you're investing $500 per month. That's $6K per year. At $100K, your money is already earning more than you're contributing. That's the psychological flip. Until you hit this level, it feels like you're pushing a car uphill. After you cross it, the engine starts helping. This is when compounding stops being theoretical and starts being visible. Now let's go to $250K. At $250K, 7% is $17.5K per year. If your household expenses are $60K, that means nearly 30% of your lifestyle is being funded by market growth alone. You're not financially independent, but you're not fragile anymore. And here's the psychology behind it. When your investments generate more than your annual contributions, you stop seeing saving as sacrifice. You start seeing it as leverage. Now you might be thinking, but Tom, markets go down. Yes, they absolutely do. And this is where most people mess up, because when you have $20K invested and it drops 30%, that's $6K. Painful. When you have $250K invested and it drops 30%, that's $75K. Emotionally brutal. The dollar swings get bigger, which means the psychological discipline required. According to long-term behavioral studies from Fidelity Investments, investors who trade frequently underperform those who stay invested by wide margins. Because volatility feels like danger, but at milestone 1, volatility is actually fuel. This stage teaches you emotional resilience, and that resilience is what allows you to reach milestone 2. Milestone number 2, the coast point. This usually happens somewhere between $500K and $1 million, and this is where things get interesting. Let's do some math. At $500K, growing at 7%, you're looking at $35K per year in expected long-term growth. At $1 million, that's $70K per year. Now, pause. If your household spends $70K per year and your investments are expected to grow by $70K per year, you've effectively reached what's often called Coast FI, meaning if you never invested another dollar again and just let it grow for 10 to 15 more years, you'd likely hit full retirement funding. That changes how you work. It changes how you negotiate. It changes how you tolerate nonsense at your job. This is where retirement stops being a distant concept and starts being optionality. Optionality is underrated. The ability to say no, the ability to downshift, the ability to take a lower paying job you enjoy more. Let me tell you about a guy I spoke to, mid-40s, about $620K invested, household income around $140K. He felt behind because he didn't have $1 million yet. But here's what he didn't realize. If he never invested another dollar and his $620K grew at 7% for 20 years, it would become roughly $2.4 million. 2.4. That's compounding. He wasn't behind. He was in the acceleration zone, but psychologically, he still felt like he was in survival mode. This is the trap. Most people don't update their identity as their wealth grows. They keep acting like they're one emergency away from collapse. And sometimes that's wise, but sometimes it's limiting. Now you might be thinking, Tom, $500K or $1 million still doesn't guarantee retirement. Correct, because retirement isn't about a number, it's about income. Let's talk about the 4% rule. Historically, withdrawing 4% of a diversified portfolio annually has had a high probability of lasting 30 years or more, based on historical US market data. So at $1 million, 4% equals $40K per year. At $750K, that's $30K. At $500K, that's $20K. Not enough for most households alone, but combine that with Social Security. According to the Social Security Administration, the average retired worker benefit is roughly $1.9K per month. That's about $23K per year. So now imagine $1 million portfolio equals $40K. Social Security equals $23K. Total equals $63K. For many households, that's very workable. That's why Milestone 2 is so powerful, because you start seeing how the pieces fit together. And here's the deeper psychological shift. When you pass $500K to $1 million, your focus should change from accumulation to optimization. Taxes matter more, asset allocation matters more, withdrawal sequencing matters more, small percentage differences equal large dollar amounts. If you improve returns by just 1% on $1 million, that's $10K per year. On $100K, it's $1K. Scale changes the game. And now, milestone number 3, the freedom threshold. For many middle-class households, this happens between $1.5 million and $3 million. This is where retirement stops being about survival or comfort and becomes about design. At $2 million, 4% equals $80K per year. At $2.5 million, that's $100K per year without touching principal. Add Social Security, maybe $25K to $40K combined for a couple. Now you're talking $120K to $140K annual income potential. For most Americans, that exceeds their working income. And here's where things get surprising. Once people reach this level, the biggest fear is no longer running out of money, it's running out of purpose. Because for 30 or 40 years, work structured your life, it validated you, it gave you social identity. Money solved the financial problem, but not the existential one. I've seen people grind obsessively to reach $2 million and then feel strangely empty because they optimize for a number, not a vision. That's why Milestone 3 is about intentionality. What does retirement actually look like? Where do you live? How do you spend your time? Who are you without your job title? Now, let's address the objection I always hear. Tom, this sounds great, but I'm 42 with $180K. I'm nowhere near these milestones. Okay, first, breathe. Second, let's run real math. If you have $180K invested at 42, you invest $1K per month, assume 7% growth. By 62, that becomes roughly $1.2 million. That's not fantasy math. That's compound growth over 20 years. Even if returns average 6%, you're still over $1 million. The problem is not usually math. It's consistency. It's panic selling. It's lifestyle inflation. It's upgrading your car every 5 years. It's increasing spending every time income income rises. Retirement wealth is built in boring decades, not dramatic months. And here's the uncomfortable truth: income helps, but behavior dominates. I've seen households making $250K living paycheck to paycheck, and households making $90K with $800K invested. The difference? Automation. Low fixed expenses, and not trying to impress people who don't care. Let me simplify this with an analogy. Think of retirement savings like pushing a flywheel. At first, it barely moves. Every push feels useless. That's your first $50K, then $100K. Still heavy, but once the wheel gains momentum, each push does more. That's $250K to $500K. By the time you're at $1 million, the wheel is spinning fast. You're not pushing anymore, you're steering. And at $2 million, you're deciding where it goes. So what should you do today? Number 1, know your current number. Net worth, invested assets, not vibes, not guesses, actual numbers. Number 2, calculate your annual spending. If you don't know this, you're flying blind. If you spend $70K per year, your 4% target is roughly $1.75 million. That's your full independence number. Number 3, automate your investments. Remove decision fatigue. Number 4, increase contributions with every raise. If you get a $5K raise, increase retirement investing by at least $2K. Lock it in before lifestyle expands. Number 5, reframe market downturns. At 35, downturns are discounts. At 45, they're still opportunities. At 60, they're risk management events. Context matters. Look, retirement isn't about hitting some Instagram-worthy milestone. It's about moving from fragility to stability, to optionality, to freedom, and those shifts happen around. $100K to $250K, $500K to $1 million, $1.5 million to $3 million. Not because they're magical, but because compounding, withdrawal math, and human psychology collide at those levels. If you're below milestone 1, focus on consistency. If you're between 1 and 2, focus on discipline and tax efficiency. If you're between 2 and 3, focus on optimization and life design. And if you're above 3, start thinking about legacy, generosity, impact, because money past a certain point stops increasing happiness dramatically. Research consistently shows that beyond a certain income level, increases in life satisfaction flatten. What increases instead? Time autonomy, health, relationships. You don't need $10 million to have those. You need enough, and enough is math plus intention. So here's my challenge to you. Figure out which milestone you're closest to. Write it down. Create a plan to reach the next one. Not someday, this year. Increase your savings rate by 1%. Consolidate old accounts. Rebalance your portfolio. Do one uncomfortable financial thing this month, because the takeoff point doesn't happen by accident. It happens because you kept pushing when it felt slow. And then one day, you look at your account, and instead of anxiety, you feel control. That's the moment everything changes. If this helped you think differently about your retirement path, hit subscribe, give the video a thumbs up, and share it with someone who needs to stop guessing and start calculating. I'm Tom, and I'll see you in the next one.